Ascent Capital has just raised $100 million and want to make sense of this raise and what they intend to deploy this capital on. Let's delve into it. David, one of the facts that we must face this time round is that a number of the DFIs who are deploying capital into your kitty, the CDCs, the FMOs, the Norfund, IFC, are increasingly investing directly into these companies which you are also targeting. And the question then becomes, are you in a competitive space with the very investors who are actually giving you capital?
Two things happening, especially in the SME space. We don't think they are competing. You'd say perhaps in the bigger deal space or mid-cap space, they do tend to write bigger check sizes. So we've spoken to some of them with co-investment opportunities, and they tell us, look, if you're not ready to call up to $20 million US, then it doesn't make sense for them. So if you talk about the mid-cap and the SME space, they are not necessarily competing. Secondly, I think they must have come into the market feeling that there's a gap that's not being filled, especially with the PE money. Remember, the PE money is sort of, we call it long-term, but it has a life that comes to an end. So year 5, year 6, the PE player will be looking to sort of exit from that particular opportunity. And I think the money that the DFI, or the role the money of the DFI should play, should be in such a way that if there's a business that the PE is now exiting, having grown to a particular level, but still needs an institutional investor to be in there, potentially the DFI money will go in there. Secondly, I think the DFI money is more growth capital from what we've experienced also from them. They don't do, or they don't like doing buyouts. I think I've only heard of maybe one that has appetite for buyout, but the rest of them, money must always flow into the business. So it's all growth capital. So to some extent, you would say they leave some space for us to be able to work together with them. But yes, definitely, if you're a large cap, then you'll be finding yourself sort of almost competing with the DFIs. But also I've seen them do what we call more of cooperation rather than competition. In other words, if they see a private equity player is already looking at a particular opportunity in our particular sector, then they wouldn't be able to go in there.
So you do indicate that you are targeting MSMEs, but when I look at your ticket size, which is $5 million to $20 million, and considering that you look at the OECD definition of an MSME, some would say that in the Kenyan context, you will certainly be having a number of businesses falling through the cracks before they're even eligible for your consideration.
There are two things. When you say $5 to $20 million, it looks like a big range, but there are certain businesses that, if you look at their revenue, for example, the revenue might be very small, but the margins of the business is actually very, very good. So it's a much more profitable business, for example, yeah? And you could even go to sectors. So if you go to retail sector, you might have very huge revenue lines, but the margins are very, very thin. So for you to make any money at all, you're talking about 5 to 6% margins. Whereas we prefer businesses where you say, okay, the revenue might not be big, but the about 20%, 15% on the minimum side, but going all the way to 30%. So $10 million revenue business, but making $3 million in EBITDA. Yes. So if you put a multiple to that, then of course, the valuation of the business actually goes up. So it might not be a business that you see normally because, like you said, the revenue is much lower, but it's a very, very profitable business that's under the radar, but doing very well. Like I always say, I like what you call the non-sexy businesses, you know? You will not think about this as an investable business, but there are actually quite a number of them in Nairobi's industrial area. That's why I like plying my trade. So I'm always in industrial area looking and talking to entrepreneurs along that road. 2020 was a pandemic year. And I tried doing a small little survey on my own to figure out how many businesses are actually closing and how many warehouse space is becoming available. And I was shocked that there's not so much warehouse space becoming available. It shows you the resilience of the businesses despite the effects of the pandemic. Some of them are contracting, yes. And even some of our portfolio companies saw them contracting because of the COVID. But luckily enough, none of them actually did a cash call, sort of to rescue the business because it would go under. And calls to good management, institutions, but I was pleasantly surprised that I was looking for warehouse space and I would only get small 13,000 square feet here or on this other side, but I couldn't get 100,000 square feet altogether, which would now fit a big manufacturing business, which showed that not many businesses were closing. Some were closing, unfortunately, yes, but quite a number of the businesses were actually resilient.
What sort of exit routes are you looking at? And why this question is critical, David, is the fact that we all know that for a long time this country has been having a conversation around having PE firms and VC enterprises venturing out via the capital markets, which unfortunately hasn't materialized. If you look at Java, for example, ECP came in, they exited via another fund by the name of Abraj. Do you think this is one of the routes you could take?
We would love to list, by the way. For me, if you asked me, given my past, listing will be one of those things that you feel like you are giving back to the Kenyans through the stock market. But Julius, I'll ask you, who is the most active investor in the stock market? Is it the Kenyan?
Institutional investors.
But who?
Kenyan, foreigners.
Foreigners. So it's the same thing. It's the same thing. So you'll be told the foreign investors' interest in Equity Bank or Safaricom was like 70% and only 30% local. I think there is a bit of I don't know, a negative sentiment to stock investing, not only just in the stock market, but even in PE play. Yeah? And I don't know what the market needs to do to spur what we had back in 2004 or 5, because at the time the market was very, very vibrant.
Because the government was divesting stakes.
Yes, so there are a lot of listings.
Exactly.
But I don't get a guarantee that if I was to take one company, put it in the market, which I own 60%, I will be able to sell my entire 60%. Because if I can't get that 60%, then I'm not going to go to that market. You see? So is the market liquid enough? That's the question we ask ourselves. Is the market liquid enough? At the same time, you ask yourself, but we are managing, pension funds are managing over 1 trillion shillings, yeah, over 10 billion US dollars. Yeah, 1.4 trillion shillings. Where is that money? Okay?
Fixed income.
Fixed income. So it will take to convince Kenyans that, and you know, the Java example is a very good one, yeah? Because I tell them, look, you say Java is a local brand, you like going there, you spend your money there, but who gets the profit? The profit is going back to, money is leaving the economy, unfortunately. I also ask the question, who is the biggest single largest investor in Equity Bank? And people tell me, it's Norwegian Sovereign Wealth Fund. It's actually Norwegian pensioners.
Yes, for sure.
So if we believe Equity is a good bank, why aren't we investing in it? Why didn't NSSF bid to buy that stake? So that is owned by us. I'm an NSSF contributor.
Yes.
It's owned by us Kenyans. So that then we own and believe in our own brands.
But David, pension fund trustees will tell you that the design of pension funds, that they should be low risk. Because
then,
of the longevity of it, you know.
I completely disagree. Because then you look at the demographics of the pension fund. We are a young population. Yeah. It means we should be looking out for how many years now? We should be looking out 20, 30 years. Yes. We are not like the West, where the curve is now old and you need more cash as compared to investments. Mm-hmm. We need more investments now, because once this population we have now, when that curve moves towards when they turn out to be 60, 50, that's when we will need cash. And by that time, you should have made enough return to be able to cater for them at that particular point in time. So that perception should change. And maybe my view is it will only change with the boardroom also changing and having much more younger people sitting on those trustee boardroom. Because if you have much older people, I am growing older by the day, and I'm becoming more and more conservative. So it's nature. Yeah. And the more and more those people dominate the trustee tables, look, we've been trying to attract PE asset class to pension funds. It's tough. It's very, very tough. And I think it will take a long time before we see reasonable allocation. Out of the 1.4 trillion, I think we have maybe $30 million, 3 billion or 4 billion shillings now allocated to PE. Yes. It's real estate, fixed income, and very little on the... and then remember, the corporate bond market is dead. So the instruments you can invest in are very, very limited. And so we PE are trying to put our head in there. But also I would say that, look, what are the negatives? I think the PE story in Africa still has a long way to go, still very young. Yeah. Because exits are very difficult to make. Like I told you, when we exit, we want to sell 100%. We are out. We are coming in. If you're listing, I need to build before I go to the market. In other words, by the time I'm listing the thing, I've handed it over to the people. And having worked in the stock market in my previous life, if you don't have an anchor investor in a particular stock, danger of collapsing is very, very high. Yes. So that's why you'll always find there's Centum, there's ICDC, which is the government backing into the 20% stake. If you go to KCB, there's the bank, the government again. If you go to ABSA or Barclays Bank, what we call Barclays, so there's always an anchor investor. If I'm exiting, I'm not going to be the anchor investor because I have to give money back to my investors. Yeah, so I have to give it to all of you, and then all of you take care of it. So I think a structure needs to work out there that makes it attractive. I think perhaps at a policy level, and maybe not, I don't believe in policy, we need to be innovative enough to figure out how we can create stock investors who are significant and who can take huge stakes and help drive agendas, and reduce that holding level to 5%. In America, for example, someone who owns 5% of anything, Kalaikan was of this world. Yeah. He is a big voice because he's a 5% shareholder. In Kenya, 5% shareholder will be listening to you.
I mean, they're holding 5% of a very huge pie.
That's what I'm saying, but then he is still a significant shareholder at 5%. In Kenya, at 5%, in Safaricom, no. Probably some, but not in many places, especially where the government is holding significant stake, 20-25%. In KCB, if you're a 5% shareholder.
But then, David, now back to the exit routes here. So you've expressed the difficulties around exiting by the market.
Yes.
What are the options there?
So with the options like you spoke about is consider a bigger private equity fund, okay? I would love to see where Java is going to go eventually, yeah? When Abraj, okay, well, now it's been taken over by Actis, when they'll be exiting, where will it go? You know, my best mode would be if there were 3 pension asset managers or pension funds, so the biggest ones. So if NSSF came together with the Kenya Power pension funds and came together with, I don't know, 3 or 4 or 5 of them, and simply say, we will buy this thing. We'll go get a transaction advisor, knock that door of Actis and tell them, what are you guys thinking about this thing? And we tell them we want to acquire this thing, we want to structure it, acquire it, and list it. Yeah. That's how it should happen. Who is this person who's going to do this? I don't know. One of my biggest dreams, to be honest with you as an individual, is I think, having worked in Centum, we need to have 10 more Centums in the stock market. Okay? Because not all these businesses we have can list, but the ordinary investor can access them through a fund like us. So eventually Ascent 2 invest in 10 companies, very good. Take that Ascent and list it. Then at least you have an intermediate access to these particular opportunities, even if not listing those particular entities. I think that should be maybe another route to go. Create a permanent capital vehicle, get commitments from local pension funds, or even international investors, and say, guys, we are creating this. We are going to look at David's Ascent. You're going to look at Actis. You're going to look at ECP. You're going to look at Abraj. You're going to look at everybody else, and pick 3, 4, 5, 6 assets from there, put them together, and list it. Okay? And create sort of, we are not going to be calling for fees from you as investors. Once we put these things together, within the 3rd year, this company should be able to generate cash flows to pay management. And then it continues that and continues growing. The beauty about the PCV is that you have no exit issues in mind about, I need to get to exit. No, you should even be looking for more money to acquire the next round of good opportunities and create those kind of entities. Then from there, this person who's doing the PCV can list one of his entities and become the anchor investor. Can say, this is doing very well, Java is doing very well, it should be listed on its own right. And I'll retain 30% stake to hold it. You see, then the next one. That way it would work. And we are happy to talk to CMA, but I always say regulation does not drive innovation, to be very honest. Innovation should drive regulation. So you cannot put, I'm putting regulations so that you can innovate. No.
But now that you mentioned that, David, I must ask you this question. You and I have had this conversation before. In the last budget cycle, there was this proposal that private equity and VC be placed under the ambit of CMA.
Yes.
How do you envision that panning out?
It's a good question. We actually, to be honest with you, CMA is talking to us as an industry to figure out how it works out, because we have quite a number of regulators in that space already. We have RBA in there. We have IRA there, because insurance companies also do have asset management. So we have IRA there. Now CMA is coming into play. And I think the government set up the Nairobi International Financial Center. Okay, so we have 4. And the question is, what is the interplay within these 4? Okay, if RBA says it's okay, should I go to now CMA? Should I have, what should we be? So the warning we've given is, look, it's a nascent market. I think Ascent now will be the private equity fund with a bit of a significant holding of pension funds allocation. But you can imagine, by the time we raise 120, 130, it will be less than 10% allocation. And the question would be, do I want to go through a lot of trouble just for a 10% allocation in my private equity fund? And we've encouraged the regulators to think about it, that don't bring in regulation that then discourages players from tapping into that particular market, but more that encourages players. And in my view, if you ask me, they have to think through it very carefully, because is it fundraising aspects? Is it just regulating the whole industry aspect? Because many of the private equity funds are not domiciled in Kenya. They are actually domiciled elsewhere. So the idea would have been, study those markets where PE like domiciling themselves, what are they doing right? And then come and set up that environment here, so that then it's easier for someone raising a private equity fund to say, I'll do it in Kenya.
Having raised $100 million in the new fund, what lessons did you bring from your preceding funds which you think will be useful when it comes to now deploying capital afresh into businesses?
Quite a number, yeah? Quite a number of lessons we've learned. Well, the biggest one I would say, maybe the one lesson I would say I learned from a previous fund is it's not easy to change someone. Eh? If someone has been running a business for the last 20 years in a particular way, to think that they sign a contract today and tomorrow they will change, it never happens. So from our portfolio, we saw, and I'm being very candid about this, the companies where the entrepreneur left management and worked together with us as a non-executive role, and we appointed an independent management team, went very well. And the relationship became much stronger. Why? Because the entrepreneur is street smart. He has been running the business for the last 20 years, so he knows. He sees a table, he'll know this thing is not straight, right? The management team comes with the strategy of trying to grow and everything, so we are sitting on one side of the table, getting a conversation on execution from the other side of the table. Where we find the entrepreneur sitting on the other side of the table, when we start asking difficult questions, it becomes a very difficult conversation to have. Nobody has questioned him before. And now there are people who are telling him, no, you cannot do this. I was thinking about investing in this. I thought about it last week and I think it's a good idea. No, we don't think it's a good idea. And before you do it, please do this research, do this thing, then present a paper to us on the table. Before that, he would wake up and just do it. Okay? Now, he's finding that barrier, and that's, change is difficult. Eh? That's what I've come to learn. Change is very, very difficult. So we tend to encourage a lot of entrepreneurs to think about it, especially where we are taking a significant stake. Ask them, do you really want to remain as management? Because the first thing we will do is to give you a contract, an employment contract. This guy started the business just like that. Yes. Now you're telling him, I'm going to give you 8 to 5, 30-day leave day. One entrepreneur in Uganda told us, I'm not going to do that. There's no way I'm going to. What you mean? No. If that's the case, I'm sitting with you on this other side. Let's employ an independent MD. And it has worked perfectly. Because the entrepreneur knows the tricks of the game. And he'll know where management is trying to hide any story. So he will pick it up very quickly. But at the same time, he also expects us to add our value in looking at the capital structure. That's the value we add to businesses. We tell them, I'm not going to be clever in health services if someone has been running it. But I'm going to help in thinking about the capital structure. Do we really need to borrow this money? And if you're borrowing the money, to what level can you really borrow? And what terms do you negotiate with the bank or the credit lenders? We play a big role in that. We've also seen a lot of businesses that are being shown to us by banks. We don't buy them because I think the banks have become very careless. They ended up lending businesses carelessly.
So they're over-leveraged.
So they're over-leveraged. And by the time they're coming to, maybe you need to talk to a PE player, someone to inject equity. We look at the business maybe we can't touch. Yeah. And we ask them, let's work together. You as a corporate lender need to look at this guy, look at his balance sheet and say, look, I can only lend you 20% of what you're asking for. The rest of it must come from equity. Yeah. And where do I get that equity? Talk to private equity funds. Yeah. But there's all this thing of I want to do the whole deal by myself, and then a lot of businesses are now collapsing. So if you go to the banks' special situations, there are a lot of companies that were very good, or you still out here you see them, the brands are still there, but what's happening behind them there is terrible. Eh? Yeah. The entrepreneurs are not sleeping.
COVID-19 has played a significant role in terms of just eroding the opportunities that exist in this market, particularly among the medium-sized businesses. Does the risk profile out there bother you, and what sort of deal pipeline are you looking at least in the immediate term?
I'll tell you, our rule is always that to do one deal. This is me. My team members will tell you 10 to 1. My deal is 100 to 1. you must go out there and look for them. And if you don't have 100 opportunities, then you will probably not invest. Yeah. Okay? So for Ascent, we've already done one deal in Fund 2. I'm not allowed to mention the name. That's why it's called private equity, but it's in the financial services space. Okay, we've done one deal already. We've been looking at this deal for some time before we even closed the fund. Because we were confident about closing the fund, we started working the deal. So as we are closing the fund, we've already done an investment of about up to $14 million US. And if you ask me, we have a good pipeline. And in Kenya, we have a good pipeline. But it's not like we got it yesterday. We've been working this pipeline for more than 12 months. Okay? Actually, some of them 14, 15 months, going back to 2019. We started talking in 2019, even as we were raising the fund. So it is not, you are right in the sense that it is not like you come in and you'll be deployed quickly. We will invest eventually in 10 companies, but over 5 years. So you ask me, how many companies per year is that? That's 2 companies a year, right? 2 companies a year, exactly. But to get the 2 companies, you must look at a significant amount of opportunities. Yeah? So that shows you one thing. There is a lot of companies that are looking for private equity investment. They are. The question is, do they meet the criteria? Do they meet the criteria that's there? Our pipeline in Kenya is now rich. And I say that it goes cyclically. So in our Fund 1, we saw a lot of opportunity in Ethiopia. Okay? And it's still a very good market. This is one market I've seen companies. It's opening up. And some of our companies have been growing at 30% year on year for the last 5 years. I don't even see something like that in Kenya unless you're Safaricom or something. In Kenya, if you grow double-digit dollar terms, this is dollar terms, yes. Double-digit, you're good. You're very, very good. But even here, we've seen opportunities. Where we've seen opportunities in family businesses is where there's a succession issue. So the younger generation is taking over. But this younger generation is more sophisticated. Okay? So they are ready to take over. They want to take over with an institution. So they go look for private equity. Or they are not interested. So they're telling the folks, look, I'm happy in London or in Canada or wherever I am doing my stuff. That thing, we can retain a small stake, but I'm not going to be managing that thing. So I'm staying where I am, get David or whoever it is, Catalyst or whatever it is to come and invest and let them help drive value from outside. And then when they're selling, they also take tag-along rights. In other words, when you're exiting, you also sell together with them. They don't want to remain in there. Some we've seen where they want to retain control, but those are very, very, I'm seeing that one to be lesser than it was before. Secondly, we've seen regulation increasing. So the taxman is becoming more efficient. Okay? We remember we invest DFI money, Development Finance Institution. These are sovereign-backed funds. This is tax money from the UK, from the Netherlands, from Norway. When we invest in businesses, we tell them, no monkey games here. Okay? We have to clean up our act. We'll be, they tell you, but we'll be uncompetitive. It doesn't matter. Yeah. Sustainability means we must obey the laws of the land. We must pay our taxes. Okay? And we must pay our employees well.